Hi, my name is Rob Janezic, and I am with the Janezic Realty Group at Remax Executive Realty. I also am a real estate instructor for Central Piedmont and South Piedmont Community Colleges. And by special request from Lee Williams, we're going to be performing a qualification ratios problem here. This qualification ratio problem comes up during the home buying process a couple of times. First, to determine how much one can afford based on their current annual income and monthly recurring debts. So the bank is about to loan an individual some money to purchase an asset that's going to be collateralized by the house itself, and they want to know that they're not lending too much money to the individual based on their financial profile, credit score, assets, income, debts, etc. So it's a much more complex problem than we're going to look at here. We're going to distill it down to just two ratios, a front end ratio and a back end ratio, two independent tests that will determine how much income one needs or how much they can afford based on a given income. So again, going back in the home buying process, before you go shopping, well, what should we be looking at? So that's what we're going to look at first. And we're going to determine, based on your income and your debts, this is how much should go towards your housing payment. Having said that, you start shopping and then you find a new house that might be within that price range, but does have a whole different set of costs, taxes, HOA, etc. By that time, mortgage rates may have changed and that may change your principal and interest. So there will be another qualification later on once a house is in focus and we know the exact costs. Can you afford that house? So that's how it plays out. So without further ado, let's start. We have an example here with a buyer with an annual salary of $72,000 and some monthly debts as they show up on the credit report or otherwise. Any monthly recurring obligation has to be included in this discussion. And in this case, we have a $200 credit card, a $350 car payment, and a $150 student loan for a total of $700 a month. So first step is to determine, well, for this given income and these debts, what's the maximum housing payment that we should be able to afford? So the way the banks do that, they do it with the qualification ratios, and one of them is called the front end ratio. And what it says is that your housing payment, and let's define housing payment. It's equal to your principal and your interest. That's your debt service. If you get a 30-year mortgage to pay off a 90% loan, that's the principal and interest to pay that off. Plus 1/12 of your tax bill for the year. Every property has real property taxes due once a year, and part of your monthly payment would therefore be 1/12 of those taxes, plus 1/12 of your insurance. The bank requires you to have insurance. It's a good thing to have otherwise, even if they didn't require you. And you have an annual premium. So what's the monthly cost of that? You divide that by 12. Plus HOA dues, Homeowners Association dues. These are the dues that are assessed by your community for the amenities that they offer, for the services that they offer. Possibly an entrance and some landscaping, maybe a pool, etc. And then finally, a monthly amount of mortgage insurance. Mortgage insurance is an amount of money that you pay to an independent insurance company that insures mortgages on behalf of lenders. Lenders, when you don't have enough money of your own in the transaction, 20% is the typical amount they want you to have vested. If you don't have that, if you're borrowing more than 80%, your LTV, loan to value, is more than 80% because you're only putting 20% down, well, then they want to be insured for the amount that you're short of your 20%. And that's called mortgage insurance. And We'll talk about that in another video about how that might be calculated. But that is your housing payment. The front end ratio says that this housing payment, which I'm just going to call house now, right? And I'll define it right here. House equals housing payment equals, they call this PITI, plus HOA plus mortgage insurance. The lender says that your house payment must be less than a certain percentage of your gross monthly income. That percentage depends on the loan type. There are different loan types: conventional, FHA, VA, USDA. There's a plethora of them, and each one of them has its own qualification guidelines, and the guideline would be relative to your income. If we're talking about conventional, which we're going to talk about in this scenario, those guidelines are 28% and 36% for the back end ratio, which we haven't talked about yet. So, in this particular example, the lender says the amount that you can pay for all of your housing expenses should never exceed, should always be less than or equal to 28% of your gross monthly income. Shown another way, in this particular example, 72,000 divided by 12 is 6,000 per month. So that's the gross monthly income. If I have a gross monthly income of $6,000, never would the lender want me to go past 28% of that number. 28%. So in this particular example, using my calculator, clearing it out, and saying, what is 28% 0.28? I converted 28% to 0.28. What is 28% of 6,000? $1,680. $1,680. Your payment should never, ever, ever exceed $1,680. That would be just too much of this total pie to be safe, to be not a risk. They want you to pay your principal and interest for the next 30 years. They don't want you to stop paying. They're testing the waters here to see how sustainable is that payment. And that is going to be your ceiling. We will never allow it to be greater than that. It must always be less than that. So it must always be less than 1680 is what we just saw. 28% of 6,000. So that's test one, or as we said here, test A. And then I got test B, the second test. And that's the back end ratio. Before we go on to the back end ratio, let's look one more time at the front end ratio. Front end ratio has two variables: house payment and gross monthly income. Based on how much you bring in total, there's a certain percentage of that your house payment should be under, and will never ever exceed. This is the max. We are going to do a back end ratio. If you told me I don't have any debts at all, well then I'd say, well, we don't need to do the back end ratio because you're going to be able to go up to the max. But if you have any level of debt, credit cards, car payments, student loans, alimony, child support, etc., well, it might jeopardize your ability to go up to that. This test will yield numbers greater than this and lower than this. The ones that are greater than this, we ignore. For instance, let me write the formula down for the back end ratio. My house payment plus the sum of recurring debts needs to stay less than or equal to, and I hope we're getting this on tape, some percentage of gross monthly income. In this case, we already mentioned that for conventional loans, that is 36%. Well, naturally, if I don't have any recurring debts at all, my house payment says it needs to be less than 36%. That's going to be a number greater than this. We're going to ignore it. In fact, we're going to ignore any number greater than this. We're only going to consider this valid if it yields something lower than that. And if it does, that is our answer to the problem. That would be the maximum house price that we can afford for the given conditions. So let's go ahead and finish this math up. Again, I'm going to go back here to my gross monthly income of $6,000 and multiply it by 0.36. And that comes out to be $2,160. Well, naturally, if I don't have any recurring debts, my house payment then needs to be less than $2,160, which is greater than that, and I just ignore. But in this case, my house payment, which I don't know, and my sum of my recurring debts, which we calculated as $700, needs to be less than $2,160. So let me move this up, and hopefully you were able to see it, but we're going to go ahead and make sure you can. So now what we're saying is that my house payment plus the recurring debts, which I am abbreviating RD, needs to be less than or equal to $2,160. These we substitute $700. So when I add my house payment and $700, I need to keep it under $2,160. Well, said another way, my house payment needs to be less than or equal to $2,160 minus $700, or $1,460. So I had test A and I had test B, front end and back end. Never should my payment be more than $1,680. Also, secondarily, that house payment and my recurring debts needs to stay less than $2,160. Well, $2,160 minus $700 puts me at $1,460. This is the maximum we can leave for house because of these debts of $700, and the sum of them has to stay less than $2,160. So that's the qualification ratio problem. I hope you enjoyed that, Lee. I hope that made some sense. I will look to put out some videos and maybe in a better environment, but I did want to get it out there, especially because I have a great class at South Piedmont Community College that's finishing up right now. And they have 3 classes left getting ready for the final exam. Got another class at CPCC that's halfway through, and math is known to be a challenge. So here you go. This is for you guys and for Lee. Appreciate the support.